Well, good afternoon. Time to have a look at what's happening from a markets perspective. Starting off looking at the Asian picture, largely lower as investors digest China's April trade data that came in higher than expected. Looking at the Japanese markets, down about 2.5%. Chinese markets were mixed, and of course Hong Kong is closed for the holidays. And of course, when we look at what's happening from a global perspective, global stocks are lower. The dollar rocketing higher, almost 2-decade high. Again, it's this background of higher interest rates and the fears of the lockdown in China in terms of how that could play out from a global markets picture, and whether investors are justified in their fears that the global economy could be heading for a recession. To give us his perspective and analyze some of the latest in company news that has come out, we are joined by Gary Boyson from Rand Swiss. Gary, thank you so much for your time. So we're seeing global stocks lower and seeing that also sort of trickle into our markets. What's driving that? Is it the fears of a possible recession?
I think there's a lot to be concerned about in the global markets. We've obviously got the V-Day announcement from Vladimir Putin. I think it's actually going on at the moment, and we're going to see if there's going to be an escalation in the Ukraine conflict. And I think that's certainly got markets a little bit concerned, especially just because of the key commodity exports from the Ukraine and from Russia. When we've seen oil price shocks, in decades past, we've seen much higher inflation. You've had to have Volcker come in the Fed and really send the US into recession through very aggressive rate hikes, and you almost get the sense that that's what's playing out again this time. The problem is the traders of today weren't around back then, so certainly not the younger traders, and I think it's really a spooking clients. As you mentioned at the top, China's still in a very aggressive lockdown. If you look at some of the pictures around what's going on just with the pileup of ships, you can expect supply chain issues to continue, and then of course you look at inflation prints across the Eurozone and in the US, and it's pretty scary. We are definitely going into a time where capital is going to become more expensive. You've got the US 10-year above 3%, which we haven't seen in a very long time.
Let's focus in on China. I mean, when you look at the case for China, do you find that the bear case for it continues to become a lot stronger? And also, I suppose, as a second part to that question, is how China reacts or responds to the COVID-19 situation going to be the short-term market driver here?
I think absolutely you're going to see it feeding into supply chain issues in the real economy. That there's almost no question about that. China is the manufacturing center of the world, and if you see a disruption in Chinese supply chains, products aren't going to be produced in other manufacturing sectors just because of the integrated nature of the global economy. So absolutely it's going to have effect. But I think the question is maybe a little bit broader. If you look at China, many people have heralded China, the very authoritarian nature of the Chinese government as a huge positive. You look at something like the Three Gorges Dam, which is the largest power station ever created. It caters. It's a hydroelectric project that caters for about 10% of China's entire power needs. To do that, they had to move 1 million people. You can't do that in a democratic country. It would be very difficult. So the kinds of infrastructure projects they could push through was absolutely incredible. The problem is with that authoritarian type ruling structure, you don't have the feedback loops that you have in let's say a democracy or somewhere with freer media, and as a result you can get very odd decisions coming through, and we've seen that over the last little bit with the regulatory tightening. Things like only locally sourced PCs for Chinese government outlets, bans on video games, etc. Now it all sounds good in principle, but the problem is when you drill into that and you actually see the real world effects of suddenly only sourcing local technology and not being able to use things, the productivity in the government sector drops, for example. So I think China, you can't ignore China. The population demographics are too exciting, and there's certainly, I think, a lot of money to be made in China, but you've got to be very cautious. You've got to go in the right way, certainly, and I think for our clients we do have some exposure to China, but we like to link it to some sort of capital protection, because you just don't know what the ruling regime is going to do.
Yeah. So let's bring things locally for a bit. I mean, a lot of the mining companies have been in the news, whether it's Harmony this morning, announcing that unfortunately unfortunately, they've had 4 fatalities, or it's Sibanye Gold, rather Sibanye Stillwater, still dealing with, the situation around wage negotiations. What's your conviction on SA mining stocks?
Well, I think it's interesting. Both of those two stories highlight some of the risks that I think people have forgotten just with the massive spike that we've seen in commodity prices, and it's become so easy to go and buy things like Tungela or Exxaro or anything that was linked to coal mining, for example, because the coal price was up. Buying something like Kumba because the iron ore price was rocketing. You kind of forget about the operational difficulties that some of these mines face. Now, in Sibanye's case, obviously, both AMCU and NUM have rejected the 800 Rand increase. They're looking for 1,000, but it just speaks to the very, very fractious labor relations that South Africa has. It makes mining in South Africa very, very difficult. But that to say, if we look at the performance of the mining sector today, it is down heavily, and a lot of that doesn't have to do with those operational requirements. We've got the gold price falling, we've got the likes of Anglo Gold down over 5%, while their production update today said they've maintained their guidance. They're an ex-SA company, so they're not mining in SA anymore, but when the commodity price falls, the stocks are going to fall as well. So, looking at Harmony, mining safety. Mining is a very, very difficult operation, and of course, you want to make sure that workers are safe. It's absolutely key. It's not just shareholders that matter in any business. It's a compact between the workers, between labour and shareholders. So we hope to see the companies doing a little bit more, but it would also be nice to see the commodity prices turning around a little bit.
Okay, cool. Before I let you go, key events that you're paying attention to for the rest of the week?
I think the mining Derby is going to be interesting to watch this week. That's definitely coming up. And I think just as the earnings season continues to roll on, I think a lot of our market is impacted by what's going on internationally. So to see how the big kind of multinational companies are reacting to the changing geopolitical framework, I think it's going to be very, very interesting. So certainly going to be watching a lot of those corporate releases as well.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Boyson from Renswis giving us his perspective on the latest market developments. Of course, we are counting down to Wednesday's US CPI data, which we will analyze for you towards the end of the week. That is it from me. We're going to take a quick break and we'll have more news for you, so stay tuned.